Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report. Corey Fleck here, your host for this weekend's edition. Chad will be joining us in the back half of this first hour. Just a note for this weekend show, we're going to be focusing on markets for the type of moves that matter to investors, and we're going to be largely avoiding what the Fed had to say and what other central banks had to say this week. We covered a lot of that during our daily editorials throughout the week. And quite frankly, look, it's a whole lot of noise. I realize central banks can dictate market moves, but I think there are some bigger picture aspects that we all need to pay attention to for these markets and kind of take the central banks out of the equation sometimes. To kick off the show, I am chatting with Mike Larson, editor-in-chief at MoneyShow. Now, Mike, again, major themes. I think this should be more the consideration for investors. We can tie in central banks and their general trend to want to cut rates, but overall, what are some of the major themes that you're covering and that you're going to be focusing on at some upcoming Money Show conferences?
Sure. Well, we've tried to kind of come up with a way to talk about the big picture, what the 2024 story with quotes around it is going to be. And we kind of cooked up the idea of the big money pivot. Because there's a lot of different ways this big money pivot is playing out, right? It's in the economy, it's in government policy, it's in business strategy, and so on. I mean, if you look at what's happening this year, I mean, you mentioned the Fed. We're obviously pivoting from a Fed that's tightening to one that's either going to be sitting on its hands for a while or cutting before too long. But, it's more than that. We're pivoting from a stronger dollar environment to a weaker dollar one. We're pivoting from a stock market dominated by the Magnificent Seven names to one featuring broader participation. We're pivoting from an economic backdrop where investors were really, heavily focused and worried about recession risk. Bloomberg infamously had its 100% chance of a recession headline, to one where they're looking to kind of capitalize on a resumption of growth. You're even looking at, in sectors that everybody's kind of identified as being the next boogeyman out there, things like commercial real estate and banking. We're kind of even pivoting to some bottom fishing in there. It's sort of funny. I was just, before we got on the call, I was kind of looking at some different sector ETFs, and everybody talks about tech all the time. You look at the QQQs. Okay, great. Year to date, they're up, about 7.5% at last check. But it's kind of funny. If you said, what's up more, tech or financials, you'd say tech, but there it is. If you look at the XLF, the, year-to-date return is almost 10%. So it's beating the QQQs by a little bit. And you're seeing things like materials keep right up with technology. I mean, XLB and so on. So, and industrials are pretty solid as well. So it's an environment where you're not just having, on the stock market side, you're not just having this sort of Mag 7 market like we had a while back. That's the story of a few quarters ago. The story of this year so far is people looking for opportunity elsewhere and finding it, in terms of the stock market. I mean, heck, we're talking about the Nikkei in Japan hitting, a new all-time high for the first time. It finally took out the ridiculous bubble peak that it had in 1989. So, Japan of all things, they just raised interest rates for the first time in 17 years. Their central bank did. So again, it's just an illustration of how the big story, this big pivot, is really playing out in a lot of areas. And so I think it's a market environment with a lot of opportunity. There's likely to be new leaders, whereas, what used to be laggards become leaders and what used to be leaders become laggards. It's definitely just a big shift, big pivot environment. And that's what I see. That's what we see. And that's what I think is going to continue to be the story for the rest of 2024.
So Mike, as optimistic as that all sounds, I do hear from a number, even of our generalists that I really respect, that the market is due for a pullback. Just look at how quickly it has run, not just at the beginning of this year, but also at the tail end of last year after that October low. Do you still think we could see a general market pullback?
Yeah, it's all about timing, right? If you're a shorter term, maybe even, a trader with a time frame of a month or two, yeah, I think as we head into the end of the first quarter, beginning of second quarter, you're probably going to see some digestion of gains. You're already seeing that in parts of the tech sector that have continued to get good news, whether it's the Nvidias of the world and so on, and yet the stocks are mostly just marking time. And I think that's part of the not just rotation, but also part of the fact that those old leaders just need to stop and catch their breath. So, I mean, if you're a short-term trader and you're saying, "Oh, great, maybe I can make some downside profits, or at least find some new places to look," sure, I think that's what you're going to see. But again, the sign to me of a healthy market is that the market can withstand the old leaders just sort of losing steam, but new leaders taking their place. And, you imagine a race, a relay race where you pass the baton. The guy who runs first, he goes to the sidelines and sits down and catches his breath. As long as the person who takes the baton from him keeps running, you're in okay shape overall. So I think that's a good analogy, a good thing to think about when you look at this market as an investor.
I love that analogy. Let's go further with that analogy then. What sectors is the baton being passed to, do you think?
Yeah, I mean, again, there was so much negativity, so much worry about things like commercial real estate, and rightfully so, impacting the banks. We had the bank failures back in early 2023, but I just had a great interview with Ed Yardeni at Yardeni Research as part of our podcast, and he basically said, look, there's tentative signs that even an obvious trouble spot for the economy and the markets is starting to right itself. And I agree. If you look at things like the Fed's own data on bank willingness to lend and credit losses and so on, the worst of that appears to have happened a quarter or two ago. If you look at the monthly delinquency rates in some of these commercial real estate related securities, they peaked 4 or 5 months ago. So, it's tentative. It's not like everything's fixed. It's not like all these empty office buildings are going to, stop going down in value, and no banks are going to fail, and no buyers of these esoteric real estate securities are going to lose money. But in terms of it being sort of like, we passed the peak loss period or the peak worry period, yeah, I think we are. And I think it's just going to be sort of a slow grind in the background. So if even that area of obvious stress kind of just moves to the sidelines, then that's one less thing to worry about. Again, I don't want to sound Pollyanna-ish, but I think sometimes you have to invest for reality, and sometimes reality is really grim, and sometimes it's the exact opposite. And I'm pretty bullish about things here.
What about those interest rate sensitive sectors? If we do have rates staying generally higher for longer, could those sectors continue to lag?
Yeah, I mean, look, in this kind of environment, is everybody going to be all bowled up about buying utilities? I mean, no, because they're, it's sort of the be boring sector that I talked about a few years ago when that was working the best and the environment was the best for it. Now you just don't have the interest rates. They're really behind you, and you don't have a lot of business, or, you don't have a lot of need for extreme safety, which is why sectors like that do well. So, yeah, I mean, you're not going to see, in my opinion, much movement or much growth, in a sector like utilities or in a sector like consumer staples. That's not going to be where you're going to find your performance. I think, the market started shifting to a more offensive profile from a defensive profile a couple years ago, at the beginning of 2023. And that's, part of the reason I shifted my stance. And I think that's likely going to be the case moving forward. You're going to see, again, the growthier, more offensive, economically sensitive, cyclical type stuff continuing to outperform. So, that's where I think that the best opportunities are moving forward. So that's your transports, it's your industrials, it's your small caps, it's your financials. Again, the stuff that does well when recession fears fade and people start saying, hey, look, the growth's going to pick back up. The Fed didn't put us in a recession. So, let's start buying.
Okay, how about another sector that people continue to harp on? You've mentioned how well the financials have done, but what about the regional banks? Those have continued to struggle, and a lot of the bears want to keep pointing back to regional banks and commercial real estate as the potential black swan event here.
Yeah, I mean, look, is that a part of the market that I think is going to perform fantastically? No, I mean, but at the same time, I mean, what have the regional banks done? For the last few months, they kind of just chopped around. They're sort of sitting there. You're not seeing any more of the broad deterioration that you saw in the wake of the Silicon Valley banks of the world falling apart back in early 2023. So I think it's going to be a sector that just gradually people start bottom fishing in, and gradually, they're going to hopefully differentiate in certain names versus just buy ETFs. I think they're going to be looking for the banks within that group that don't have the, as much CRE exposure as other banks do. But it's kind of funny. I was putting together some notes and sort of a 30,000 foot up look at the market and trends that I find interesting is even amidst all this talk about regional banking and CRE, if you look at credit spreads overall, the difference in yield that a high yield or junk bond borrower company or whatever rated company has to pay over and above treasuries, those spreads have actually been coming down for the last few quarters. So they're not, you're not seeing broad credit deterioration, even as you're seeing some of these issues with regional banks and CRE in places. So what does that tell you? That tells you that this isn't a credit crunch. This isn't a credit crisis. This isn't a, bad news in one part is prompting widespread selling in the rest of the economy and the markets. And that's different from what we had in the period leading up to the great financial crisis. I mean, one of the problems there, or one of the reasons it got so bad, is that what happened in mortgages, subprime mortgages, and housing didn't stay bottled up there. It spread throughout the system. And if you look at some of the same indicators now that I looked at then, that made me much more worried then, they're not causing that kind of alarm now. So again, it's a different animal. And I think people who just say it was residential back then, it's commercial this time, they're just, that's whatever, 6-inch deep kind of analysis that's not looking way below the seas, which I think you have to do if you're a serious credit analyst.
Let's also talk commodities then, because we look across the board on commodities. Some of the major commodities, copper above $4, oil that's above $80 right now, natural gas that's in the dumps, but gold that's above $2,100 right now. It's been a better commodities environment along with this better environment for a lot of other sectors. What's your outlook for commodities broadly?
Yeah, again, look, I've loved gold for a long time. You and I have talked about that. I liked it 2-3 years ago. I like it even more now. I mean, you've got the technical breakout on top of the fundamentals that were aligning for quite some time. So still very bullish precious metals. As I mentioned, I mean, copper is another obviously economically sensitive commodities, whether it's copper, whether it's oil. If people are starting to buy transports, if people are starting to buy materials, if people are starting to buy these commodities, if people are starting to think we did dodge a recession, there's kind of a narrative there, right? The market's telling you, if you're looking at all these different developments, that things are getting better for growth. So in that situation, yeah, I don't think that that's bad for precious metals. I think it's good for precious metals and base metals and commodities. So again, I think that all fits into the narrative of, hey, we dodged recession. Hey, growth is probably going to get better here. Money is probably going to start getting easier. It's not going to go back to zero, but hey, it's not going to be you wake up every day and the Fed's got a cudgel waiting to bludgeon you over the head with when it comes to interest rates, and therefore the dollar takes off. So that I think that part of the market is attractive as well.
What are some of gold's catalysts then? If the economic environment is looking better, is gold's main catalyst then just that central banks aren't going to get a whole lot tougher, a whole lot tighter with monetary policy?
Yeah, I mean, that's going to be a big part of it, that the monetary policy environment and the follow-on impact from that, aka a surging dollar that we had in 2022. Those aren't going to be issues, so that moves out of the way. You're still looking for people that are looking for kind of an alternative to if money growth reaccelerates, whatever you want to call it, this sort of currency debasement or government debt, things like that. Those are always going to be an issue where people are looking for ways to find a store of value. I think, it's funny because I still see a lot of those debate kind of issues. Oh, Bitcoin or gold, which one should I buy? Which, to protect myself from money printing and currency debasement and just government debt and all those other big picture issues. And I say, look, I use my emojis to signify what it was on Twitter. And that was, next to Bitcoin, I put a rabbit, a hare. Next to gold, I put a tortoise. And I said, I still think both win this race, but it's just they're both assets that are going to win. It's just Bitcoin is sort of a turbocharged version of it and gold sort of the slower moving. But hey, you can make money in both, and you're going to have smaller drawdowns and less risk and volatility in gold than you are in crypto. So I think that those are all part of the same narrative, and that's why I still remain bullish on precious metals.
All right, let's talk Bitcoin then, because look, Bitcoin continues to be volatile, and it was recently over $70,000. Then it sharply pulled back. This is all coming on the back of more positive news just broadly out of the crypto space. What do you think are some of the key drivers for Bitcoin and broadly when it comes to cryptos? Is the outlook just that much better because of ETFs and just more people seeming to get on board?
I think ETFs and mainstream money flowing into that asset class. Yeah, that's a big catalyst. But I think it wouldn't be if you just all of a sudden launched a bunch of Bitcoin ETFs, but there wasn't an underlying story that people believed in and that was had the benefit of being true. You're looking for ways to protect your money from, again, sort of government debasement and all those things. You wouldn't see the fund flows that we have. But I think, yeah, you're looking at Bitcoin by opening up the doors to mainstream participation and doing it in the way where these ETF sponsors are acquiring or sourcing actual Bitcoin to back those ETFs and so on. Yeah, I mean, it's all part of that same bullish trend. Although, again, understand that, or listeners should understand that that's turbocharging the short term because all this money's pouring in. But longer term, I think you're going to see, the initial euphoria wear off a little bit, but you're going to see the gradual fund flows come in as Bitcoin as an asset class is more institutionalized. So, it'll become more stock-like or gold-like over time and a little less turbocharged over time, I think, as, it becomes more of a mainstream instrument. So short-term turbocharge effect, long-term gradually supportive, in my opinion.
So, Mike, outside of just price moves, and I know price moves dictate a lot for any sector, even for any individual stock, what do you use chart-wise or just anecdotally to judge general interest in different sectors when we do have a generally better environment out there?
Yeah, sure. I mean, it's fund flows. I mean, that's something I think is easier to map and watch, especially because there's so much tracking of ETFs, and that's where a lot of money has gone into. It's easier to follow that. So I think fund flows, sentiment surveys. I mean, and frankly, being with MoneyShow and having access to the presentations and the articles and the videos and so on that our contributors do, I kind of like to keep my finger on the pulse of what they're saying because I know who's generally been right. I know who's seems to be probably most in tune with the market, so I'll pay attention to what he or she has to say a little bit more than some of the others I haven't followed for a while. And I think what I'm saying pretty much aligns with what most of our experts are. I would say there's quite a bit of enthusiasm for things like AI and tech and that sort of niche there. Even after the big run, I think there's a lot of belief and understanding and expectation that this is a real technology. These are real companies. These aren't sort of the fly-by-night.coms that we had back in '99 that ultimately blew up on you. And as much as things are over enthusiastic maybe in the short term, there is a real long-term business use here, and that's leading to real revenue, real earnings, and so on. So in any event, I think that's part of that's another part that I don't quite follow as closely, but certainly a lot of our people are talking about. A lot of those people who are talking about it are not just Johnny come latelys. They are people that have been talking about it for several quarters, a couple of years now, and have been right as rain.
So outside of AI and tech, which I think there's no denying the growth that has happened in tech over a longer term than AI, but boy, oh boy, has AI just exploded recently. What are some of the main growth sectors that people are talking about at Money Shows that have caught your attention?
Well, I'll tell you, I think there's a lot of speakers, a lot of narrative about, the appreciation for and understanding for big oil, big energy, traditional energy being a big player and a value play here, despite all the hoopla you get in terms of alternatives and EVs and so on. And I think that's been a story a lot of people have been speaking about even when nobody wanted to think about big oil and was all about EVs. And now what do you see happening? You see EV demands tailing off, the technology, it's costing an arm and a leg to get your EV repaired. The battery tech has maybe been oversold and overhyped, and in reality, it's we're still going to be sort of in an internal combustion world for quite some time. So I think that's actually if you're looking for like a kind of a value type play, I think a lot of people have stuck with energy, traditional energy, and just like we were talking about earlier, what's starting to perk up, what looks like it might be breaking out here, it's traditional energy, it's crude. So I think that's a sector that maybe hasn't run yet, but if you're looking for what might run next, there you go.
Does that mean you're fading some of this new school energy or green energy initiatives over some of the old school energy?
Yeah, I think it's just a question of value, momentum, and frankly, a gradual appreciation that whether it's public policy, whether it's investor enthusiasm, whether it's embracing of a technology that might have been oversold, and the reality is that most of the world is still going to be very slow moving on this. I think all of that kind of factors into what's going on. It doesn't mean that there's no future for alternative energy. It will obviously be the future. It's just to get from point A to point B is going to take a lot longer, and the companies focused on point A technology are going to make a lot more money and do very well for a much longer period of time than I think people appreciated.
Okay. Well, then before I get you out of here, I guess just in summary, this continues to be a strong market, one that could even continue to broaden out. So, in a way, now is, I guess, probably a good time for investors to be diversified in a wide range of sectors playing alongside.
Yeah, I mean, look, this is a market where if you're completely overloaded in tech, everything you own is Mag 7 or similar type names. Look into some of these things that are starting to pick up that baton, whether it's energy, whether it's financials, whether it's small caps, industrials, things like that. Look in, it may not be as exciting or sexy as talking about AI names alone, but you know what? That's where I think you're going to see relative performance from, especially as the economic fears ease. You're going to see things like, as you point out, industrial commodities perk up and the companies that are levered to them. I think, gold and gold miners, silver and so on. I mean, these companies have are such sort of small market caps relative to the market. And if you start to see momentum there, just even some of the mainstream money moving into them can have a pretty big outsized effect. So I think those are the types of things you want to be looking at for the next leg of this move, as opposed to just, worrying about what's already ran very far.
So one final comment on that point, then you said gold miners, even the other miners and other major companies, or less so the majors, but some of the mid tiers and all that, they continue to lag these underlying stronger commodity moves. Why is that?
I think it's just because a lot of the younger fund managers, people who haven't been around for a long time, they're wrapped up in the excitement of the companies levered to the quote unquote new gold, Bitcoin, things like that. So they may not be paying attention. They may not be directing money to some of these, old winners that win in this kind of cycle. But that doesn't, those who have been around the block for cycles before know that as that changes and as as the underlying commodity continues to move, people are going to say, shoot, do I really want to miss out on this just because 2 years ago I didn't want to listen to that old guy in the corner talking about gold miners. So I think that's where you're going to see the realization hit some of the money management industry and some of the fund managers out there. And that's why I think that, as long as the underlying is doing what it's doing, and if I'm right about it continuing to do what it's doing and accelerating, then that's going to be ultimately bullish for some of these companies involved.
All right, Mike, great having you on the show. Thank you for sharing your insights and also some of the insights you're garnering from all the recent money shows. It's great having you on the show, and I really appreciate your level-headed approach to these markets. You've been calling these markets right for years now. Everyone, Mike, again, is editor-in-chief at The Money Show. I will post a link to Money Show website so you can all find out about the most recent upcoming conferences. Mike, have a great rest of your weekend.
Great. Thanks for talking, Corey. Have a good one.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout. Providing unique reporting on markets and companies since 1990. This is the Corlin Economics Report.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report and continuing on with the trend from those first two segments. We're going to be focusing on many different sectors within these markets and a lot of strength that we continue to see in these sectors. These two segments being recorded after the Fed meeting on Thursday. And boy, oh boy, we saw just a continuation to the upside in a lot of sectors. We're chatting right now with Dana Lyons, fund manager based out of Chicago and editor of the Lionshare Pro website. Dana, I'm going to start off with the same question that I asked Mike in the first segment here is these U.S. markets continue to extend higher, but we keep on hearing about how a pullback is due. Are we going to get a pullback sometime soon in these markets, Dana?
Yeah, good question. And again, it depends what market you're talking about. The broader market, the broader U.S. equity market has pretty much been going sideways since the beginning of the year, for the most part, whether you look at the value line, the median stock, or the smaller cap averages, which basically is topped out the first of the year or just before the first of the year and more or less gone sideways since. So that's, the better part of 3 months of moving sideways. So I would say that's in a way, in essence, some sort of a pullback or at least a consolidation or reset that stores up potential fuel for the next extension of the rally. If you're talking about, tech stocks, AI, semiconductors, mega caps, that type of thing, yeah, those are extended still. We haven't seen any type of material pullback in those stocks. So a little bit of a breather there, like we've seen in the broader market, would not be surprising nor unhealthy. But at the same time, just because markets continue higher doesn't mean we necessarily need a correction or a pause. It's best, ride the trend. It doesn't mean when you're considering investment selection, doesn't mean you have to chase those things that are up on a rope. You can find other newer relative strength names that are plentiful within the market, that aren't as extended, that might participate to a greater fashion in the next part of the up leg.
Well, Dana, let's pull on that string for a second, because to your point, if you look at just the broad market indexes, the weighted indexes, they're telling a different story than the equal weight indexes are, or the small caps or the mid caps. So instead of chasing the high flyers, obviously, you don't want to be shorting them because they're still moving higher. There could be a lot more opportunity in the wider market breadth. So are there any sectors within, the broader markets that have your attention as maybe a better setup that haven't run as much yet?
Yeah, sure. Like we talked about last time, we were buying biotech and the pullback over the last week or so, because biotech, healthcare in general, had more recently broken out, hadn't run as much, just pulled back towards the breakout point. So that's one example in a sector. Looking at the broad market in general, you look at something like the equal weight S&P, which is, I guess, over the last couple of weeks, been kind of consolidating at those former highs that they set back at the beginning of 2022. So basically, yeah, they've had a nice run in the last month or two, but basically have gone sideways over the last couple of years. So I think there's significant more upside potential in something like the equal weight, or something like the mid cap average, which is doing the same, pretty much paused at former highs before trying to break out. And then a couple of pure value plays that we've talked about over the last couple months that are pretty indicative historically of risk on versus risk off. So if they're running higher, it's a good sign of risk on. And you have something like the mid cap pure value, RFV would be a ticker symbol, or the small cap pure value, RZV, broader value plays that have pretty much gone sideways over the last 3-4 years or so, and have just started to move to the upside. So we had, a nice move in those areas in the fourth quarter, ran up, either broke out or ran up right to former highs that have also moved sideways over the last 3 months. Those look poised to potentially break out and extend their run higher. So if we do get signs from those, or evidence from those areas of a breakout new up leg higher, that would be certainly a sign to us of continued risk on in the market, which and potentially an acceleration of risk on, at least in the near term. So those are a couple areas that are not extended that you could, even if you're, pulling your horns in a little bit in some of those tech areas, roll some money into these areas that so you're not moving money out of the market, but you're not necessarily in those high flyers that are more, at risk of some sort of a pullback.
Very interesting. Yeah, look at those mid caps and even the small caps. They are starting to break out after what you just outlined, kind of a consolidation period. That looks like there's potential there. Are there any sectors that you're flat out avoiding, not because they've run too much to the upside, but because they've underperformed so much and they just haven't broke out? They're not even threatening to break out?
Yeah, I mean, even as we talked about the last couple of shows, that, there's the array of what we call relative strength, or names that are performing well. There's certainly plentiful names out there, and one sign of, or another piece of evidence gives us confidence in the sustainability right now of this rally, just the breadth of areas that are performing. at the same time, it doesn't mean everything's performing. So some of those defensive names, sectors, utilities, for example, haven't done much. Maybe it's time for some rotation in there. I don't know. Real estate, some of the real estate names, consumer staples has shown some signs of life, hasn't been great. But again, if we are going to have further, extensions to the rally, you should probably see money eventually rotate into those names. But until that happens, we're satisfied to keep our money elsewhere as long as those areas that we do have our money in continue to perform. That's where we'd like our money. Once we see evidence of kind of a shift in relative strength, then we're happy to shift.
Well, Dana, just in listening to those sectors, thinking about real estate or thinking about utilities or consumer staples, those are really in the value camp. Are you more leaning towards staying with growth right now then versus value based on those comments?
From a pure sector standpoint, yes, because that's what keeps showing up on our screens, on our scans, as leading the way from a relative strength standpoint. But on the flip side, looking at some of those cap weighted or cap based pure value plays like the mid cap and the small cap pure value, there's signs there that those areas in particular might be setting up to lead the next up leg of the rally. So I guess it's maybe a barbell approach to some extent, or just more of just a diversified portfolio right now for us. Again, the key in diversifying for us though is whatever we put our money in, it has to be performing right now. We're not diversifying just for the sake of diversifying, because most of the time there are areas, you look at utilities or whatever that have been lagging that, all right, if you are diversified across everything, there's some areas the market is going to be, dragging on your portfolio. We prefer to try to avoid that and just concentrate in those areas that are performing the best. And again, if there are a wide array of sectors of market segments that are performing that we would call relative strength, all the better as far as we're concerned.
All right, Dana, let's shift into a couple commodities then, starting off with gold. You know how we like to talk about gold, and well, that's also been on a run on a daily, weekly, and even monthly basis, very close to some overbought levels. Gold just touched 2,200 midweek. I know you've been riding that gold train. How much longer, how much higher could gold go?
Yeah, well, I'm considering it just broke out. I mean, it could be substantially higher. This is, it looks like the breakout that we've been waiting for. Again, gold's pretty much gone nowhere for the last 3 or 4 years. So again, storing up some potential fuel, some potential buying demand once we do see the breakout, which we've seen. So just looking at GLD trading around 200, I would say we definitely see up above 220 next, and eventually 240, I would say, would be reasonable targets if this breakout is legit, which again, I don't see any reason why it shouldn't be. Obviously, in modern times, you have more of chance of seeing false breakouts, false breakdowns in the short term, because I think hot money chases after it, and the Johnny come latelys tend to get burned by the pros. So I wouldn't be surprised to see, some kind of a pullback, maybe. But if we do pull back towards that breakout area around that 190 level on GLD, it certainly would be adding to our position there.
Well, Dana, let's look at the rest of the precious metals complex, silver and the precious metal stocks. I know you look at SLV for silver and then also something like GDX or GDXJ. How are you looking at those other components of the precious metal sector?
Right. So as you know, we've been holding smaller positions in the miners, expecting breakout in gold and expecting that to pull up those miners and those equity positions eventually. And looks like that has started. So happy to see that. This certainly is a lot of, after several years of rough trading, there's plenty of chart resistance to get through at this point in most of those miners positions and ETFs. But we're starting to chip away at that. And if miners, the equities do decide to start catching up to, the metals, we could see really an acceleration of that move to the upside. And I would say probably the moves would happen pretty quickly. So that's one reason that we've kept the position mentioned in the past, is more of we viewed it more as like an option position. We think we're pretty confident it's going to eventually move. Just don't know when, and when it does happen, we want to be there to catch it. So that's where we're at. Another one that is interesting to us is the copper miners, which has really moved nicely over the last week or so, moving up towards 52-week highs and leading the way among the miners group. So I'm sure fundamentalists are going to look for some reasons behind that, and maybe your viewers have some theories behind that. Honestly, we don't really care as much as we want to capture what is happening, even if we don't know why. But the move in copper miners has been certainly encouraging, and to some extent, copper itself.
Man, look at that COPEX chart. Look at that volume spike. We haven't seen volume like this, well, in the chart that I have going back over 10 years. Do you care at all when you see a volume spike as great as we have seen in the copper miners ETF COPEX?
Yeah, again, like I mentioned, we don't look at volume a ton. Typically, volume's pretty predictable. Typically, you see lower volume on up moves, and then you see the highest volume in down moves, especially at lows. So the argument that these up moves are not coming on much volume doesn't really carry much weight to us, because it's usually during those panicky fear type environments that you see an uptick in volume, whether it's a particular security or across the board in the broader market. So to your point, when we do see an uptick in volume on an up move, especially coming off of kind of doldrums down here after we've traded sideways for a while, when you do see a spike up in volume on those types of moves, I think it does mean a little bit more to us. It gives us a little bit more confident that, okay, maybe this move is durable, as opposed to, okay, if it comes after a long up move, then it's more likely a sign of maybe the ending of the type of move. But right at the beginning, definitely I would rather see big volume there than not a lot of money moving into it.
Yeah, Dana, nice to see some of those moves in the copper miners on the bigger volume. And I think some of it has to do with copper piercing above $4 again, getting investors excited about it. Let's talk about a sector in the commodities that's not been as exciting, but it has had a recent move higher, and that is the energy space, oil and nat gas. In particular, oil's back above 80 now. Do you think that has some legs to run to the upside, or is that just a momentary blip higher?
Yeah, oil to us can kind of been range bound. Hard to get too excited. There have been a number of assets that I would categorize there, including a lot of the currencies. But oil's been kind of more or less range bound. Hard to get too excited about it either way. But definitely showing some signs of strength of late. As far as some of the energy equities, I'm a little bit more excited about those. They've had a rough, really underperformed since the equities in general bottom last October. I think part of that is because they outperformed during that third quarter pullback in the equities. So a little bit of a rotational effect there. They are certainly showing signs of life. We got seeing some areas in the oil space and the energy space moving back to new highs already. So that's good to see. And if there are legs to this oil move, which appears to be just starting, certainly there should be plenty more legs in the energy equities as well. So we're maintaining a little bit of a position there. Like to see, we've got a small cap energy ETF. We'd like to start leading to the upside as well.
Yeah, the small caps seem to have lagged broadly for a lot of commodity sectors, but you look at XLE, the larger energy stocks, that's breaking out. What about natural gas, though? Because, boy, oh boy, we have a lot of people consistently trying to pick the bottom in natural gas, saying it can't get much worse than it just was, down at about $1.50, but it hasn't really rebounded all that much, and the equities haven't done anything. So, any life in the natural gas sector, the natural gas equities?
There's a penny stock that I look at. We don't trade much in the way of individual stocks for our clients, so I couldn't tell you all the names in that sector. This one that I've been looking at has been certainly running for the last 6 months or so. So maybe that's a sign of life, potential life in natural gas itself. I don't know, but I do know they don't call natural gas the widowmaker for no reason. It's been a difficult asset to trade for many people, and I would put ourselves in that category. So unless there's something extremely compelling to us, I typically shy away from that. But right now, I don't see anything particularly compelling. Maybe from a contrarian standpoint, that's a bullish sign, but right now, I don't see anything.
Well, Dana, while we're talking energy, we've talked a couple times about the uranium space, both the metal and the mining stocks related to uranium. How are you looking at that sector right now after it's pulled back for the last couple of weeks?
So that's a good example of the short-term breakout and breakdown effects that I was mentioning earlier. In modern days, is more likely to see a false breakout or I should say, breakouts fail temporarily, at least in the short term, before turning around and running higher. So you get people jumping on the breakout that honestly 30 years ago would have been pretty reliable to dump money into on a breakout and get a nice run after that. Now it's typically a rug pull. So in the short term, we did see a rug pull in the miners, in uranium itself, broke initial support, which led the way down to the next level of support, which is held nicely. We got to get back up through what I would call the pivot level in uranium miners as well, which more or less comes in around the 50-day average, which we don't place a ton of stock, but just looking at each of those charts, I would say that the key level to watch would be around that 50-day average in those areas. If we can decisively move back above there, maybe we start that next leg up in that space.
So, Dana, let's then look at the bond market here because yields have rebounded throughout, I guess, this year. We had a little bit of weakness at the beginning of March, but the 10-year has been broadly above 4%. I know that you're on the long-term view that rates should continue to rise. Have we seen a renewed bearish market for bonds that will drive yields higher?
Well, again, like you mentioned, we're very bearish probably over the next couple decades on bonds. I think yields go much higher. But at the same time, nothing goes in a straight line. I think this area around 4% that you mentioned is extremely important, both as a retracement from prior highs, including the highs back in the early 80s, as well as some retracement support from the lows in 2020. So we are above there now, trading somewhere around 430, I believe, but can't really get anything in any separation from that 4% level to the upside. So right now, I think the jury is still out as far as are we, back above 4% to stay? Or did we see, at the end of last year, that move up above 4%, spiked up to 5? That might still be a one of those false breakouts that we were just discussing, and setting the leg for maybe one more pullback before we do decisively move higher. So I know that doesn't give you much of an answer on the one hand, on the other hand, but in our view, yes, we're above that 4% level, but jury's still out. I would not be shocked to see that 4% level give way and shoot back down towards that 3.25, maybe even 275 level before maybe bottoming and then moving higher decisively again.
Well, Dana, when we're talking interest rates, it also makes me think of currencies. You mentioned that a lot of markets are still kind of stuck in a range. That's how you were looking at the oil market. And you mentioned a lot of currencies, same thing. How are you looking at the greenback, the US dollar? And then are there any other currency pairs that have your eye?
Right now, again, dollar's basically right in the middle of the range. It's been in for well over a year now, I guess. So our niche is really in the equity market. So 90+% of our allocation typically going to be in equities unless we see something substantially compelling in other markets. Right now, we don't see that in the dollar and currencies, so it doesn't give us much of impetus to aggressively trade that market. I know other people may focus or may have an expertise in the currencies more so than we do, so they might have different opinions, but right now we don't see anything extremely compelling. I would say where the currency has helped us has been in some of those hedged currency instruments, the foreign equities that are hedged in currencies, whether it's Japan or Europe. Ticker symbols would be DXJ and HEDJ. Those have been two of the best performing positions in our portfolios for a long time. They are extended, certainly, so it doesn't mean you go out and chase them, but they continue to run to new highs and show relative strength. So from that standpoint, if price is a good indicator, which it typically is, that would suggest to us that this strength in the dollar may continue, that the weakness in other currencies may continue, but that's just purely from watching the charts of these other instruments, which continue to fly higher. So that would be probably the most significant currency observation I would have right now.
So Dana, I guess big picture, stepping back, it sounds like you're continuing to see a lot of opportunities out there. Some sectors that have lagged the Magnificent Seven or the high-flying tech stocks, they're starting to break out. Are you right now more diversified than you have been over the last year or two because of all these different opportunities you're seeing out there?
Yeah, absolutely. We've got probably more positions than we've had on, and like you mentioned, a couple of years. I guess back in 2021, we saw a nice broad advance, but outside of that, we haven't seen many examples of what, again, we would call relative strength in a while, certainly since that move about 3 years ago. So, and again, that's probably, if you ask me what's the best sign of, a sustainable or a high confidence rally in the equity market, I would say it's the breadth of the rally, the broad base, how broad based the rally is, how much participation there is. And we're still seeing a broad participation in the rally. Like you mentioned, there are no shortage of market segments across the board that are participating in the rally, and that gives a stronger foundation to the rally. Suggests it is more apt to continue. Once you see some of those relative strength names starting to fall off or fall by the wayside, then you start to get a little bit concerned about the durability of the rally. But right now, I would say you still see enough participation, broad participation, to give us confidence to maintain a substantially long portfolio. And again, you look at just the one data point within that space would be the advanced decline line, which continues after breaking out to a new high a couple weeks ago, continues to move to new highs. So that is just one. If you're going to look at one indicator, that's one good one to look at in terms of confirming the breadth or confirming perhaps the sustainability of this intermediate term rally.
All right, Dana, thank you so much for sharing your thoughts right now. And it has been for a little while a good environment to be invested in a wide range of sectors. Who knows how long this will continue, but it sounds like from what you're seeing, there could be some further legs to this rally. We'll definitely follow up with you in another couple weeks, but hey, in the meantime, keep up the great work. I love reading over the Lion Share Pro website, all the content you send out. And for everyone who wants more information on that, you just have to click that link within the Weekend Show posting. Dana, thank you for your time on this Weekend Show. Everyone, thanks for tuning in to the Weekend Show. Please remember to go back through our website, kereport.com, and podcast and YouTube page under The KE Report to keep up to date with all our daily editorials. Everyone, I hope you have a great rest of your weekend.